Hi, welcome to the Crypto Republic. Before we begin today, if you're serious about staying ahead in this once-in-a-lifetime financial shift, make sure you like this video, drop a comment, and subscribe to the Crypto Republic. Hello XRP Army, and welcome back to the Crypto Republic, your go-to channel for the latest energy updates and digital assets. Before we get started with today's business, make sure to smash that like button, ring that bell, and subscribe to the Crypto Republic, bringing you updates every day at noon and 4 p.m. Eastern Standard Time. And here at the Crypto Republic, we give you the bird's eye view, a satellite perspective to spot the big picture shifts while everyone else is stuck in daily chaos. Just a reminder, this video is for educational purposes only. This is not financial advice. Always do your own research before making any investment decisions, always. Well, ladies and gentlemen, something just happened and almost no one caught it. A brief moment, a subtle comment, easy to overlook. But when it came from one of the most powerful institutions in global finance, and it involved an asset many believe isn't even part of a mainstream institutional conversation yet. BlackRock made a comment that some are now interpreting in different ways. And if you understand what that moment could represent, not what it confirms, but what it might suggest in a broader market context, it may change how you view XRP and where the market is heading next. Because this isn't about what institutions publicly confirm. It's about how narratives and signals evolve beneath the surface. Ladies and gentlemen, I just want to thank everyone that takes the time to like, comment, subscribe, and share these videos. These few things really do help us out very much. And to everyone who's new to the Wolfpack, our videos are broken into two pieces. The second piece is a rant where we go over everything that's financial. Now, with that being said, let's dissect this. The reset. Let's zoom out first, because none of this makes sense unless you understand where we are in the cycle. Over the past cycle, crypto experienced something extreme. Valuations expanded rapidly, projects with limited revenue, limited adoption, and early stage infrastructure were trading at extremely high multiples in some areas. But then the environment changed. Global liquidity tightened, interest rates rose, capital became more selective and expensive. And just like that, the entire market structure reset. Now here's what matters most about resets like this. They are not the end of a cycle. They are the beginning of a repositioning phase. Because historically, after excess is removed from markets, capital doesn't disappear. It becomes more selective. Let this sink in. That's massively important. And here's where it gets interesting. It tends to move away from speculation and toward infrastructure and utility. And that's exactly what we're appearing to see now. The institutional filter. Now enter institutions, because their behavior in the phase is very different from retail investors. Institutions are not reacting emotionally. They are filtering opportunities based on strict criteria. You've probably heard the narrative, institutions only care about Bitcoin and Ethereum. At face value, that sounds simple and logical. But that statement is more of a general framework than a complete picture. It reflects how institutions communicate publicly, not necessarily every area they explore internally. And this is important. When institutions evaluate the crypto sector, they filter out most assets based on risk, regulation, and maturity. And once that filter is applied, only a small portion of the market typically remains relevant. The question becomes, which assets are positioned to survive that filtering process? The BlackRock comment context. Now let's talk about the recent moment involving BlackRock. A comment or discussion from within the broader institutional environment has circulated and it has led to renewed attention around XRP. Some interpret it as exclusion, others interpret it as neutrality, and some see it as part of a much broader institutional conversation. But here's the important point. Different interpretations can exist at the same time, because institutions do not communicate in simple signals. They operate through structured messaging, timing, and regulatory constraints. Important context most people miss. Institutions are not public commentators. They are regulated entities. That means they cannot freely promote assets outside of approved frameworks. They operate under compliance and legal restrictions. They communicate based on product availability and internal policy. So if an institution is not actively promoting an asset, it does not necessarily indicate absence of interest. It simply reflects communication boundaries. And that distinction matters. Follow the broader signals, ladies and gentlemen, because in markets like this, the most important information is not always in headlines. It's often in broader patterns and flows. And what some analysts and observers are discussing right now is a gradual shift in attention across digital assets. Bitcoin remains the most established. Ethereum continues to see ecosystem development. and XRP is increasingly being discussed with certain institutional and infrastructure-focused conversations, not as a confirmed allocation trend, but as a broader part evolving narrative. And that distinction is critical. We are not talking about certainty. We are talking about interpretation of signals. So why XRP enters the conversation? Now we need to understand why XRP is even part of this discussion, because XRP is not positioned as a store of value like Bitcoin, a general smart contract platform like Ethereum. Instead, it's focused on a specific category: financial infrastructure, payments, settlement systems, liquidity movement. These are foundational components of global financial rails, not speculative use cases, structural ones. Here's real-world development context. Over the past several years, Ripple has engaged in discussions and partnerships across financial institutions, payment networks, central bank-related initiatives in some regions. These developments are often discussed publicly in varying levels of detail. Some are confirmed integrations. Others remain exploratory or part of ongoing industry developments. And this is important to frame correctly. Not every partnership implies immediate large-scale adoption, but it does reflect ongoing experimentation and infrastructure building. The tokenization trend. Another major macro trend is gradual shift towards tokenization. This is so huge. This includes discussions around digital representations of financial assets, on-chain settlement experiments, dollarization of traditional financial instruments. If this trend continues developing, it introduces a new requirement: interoperability between systems, because tokenized assets still need liquidity pathways, settlement layers, cross-system connectivity. And this is where infrastructure-focused technologies become part of the broader discussion. Infrastructure and market role. Institutions and financial systems are increasingly exploring infrastructure that can support high-volume transactions. Cross-border settlement concepts, integration between traditional and digital systems. This is not about speculation. It's about system design and efficiency. And XRP is often discussed in the context by analysts and market observers, not as a confirmed leader, but as part of a broader category of infrastructure-focused digital assets. So when you look at the regulatory environment, now let's talk about regulation, because nothing in this sector evolves without it. Regulatory clarity is gradually progressing in multiple regions. Discussions around frameworks for digital assets continue across governments and industry groups. And while timelines remain uncertain, the direction of travel is toward structure and compliance. This matters because institutions require clarity before deeper participation. Without regulatory frameworks, large-scale integration remains limited. One important factor often discussed is XRP's history within regulatory environments. It has operated under legal scrutiny. XRP positioning context. One important factor often discussed is XRP's history within regulated environments. It has operated under legal scrutiny, extended regulatory discussions, ongoing classification debates in different jurisdictions. Regardless of perspective, the history means XRP is frequently included in compliance-related conversations more than many newer assets. Let that sink in. That's massive. That does not guarantee outcomes, but it does influence how it is discussed in institutional contexts. Here's the short-term versus long-term. In the short term, markets remain highly narrative-driven. Sentiment shifts quickly. Headlines influence price action, and volatility is normal. But in the long term, markets tend to follow broader structural forces: adoption, regulation, infrastructure development. And those forces evolve more slowly than price movements. Here's the big picture frame. If we zoom out completely, we are moving towards a financial system that is increasingly digital and interconnected. Assets may become more tokenized. Settlement systems may become more automated. And liquidity may move more efficiently across borders over time. In that environment, infrastructure becomes a central focus, not hype cycles. My final thought. So when you hear references to institutions, assets, or commentary like recent BlackRock related discussions, it is important not to interpret anything in isolation, because markets are not driven by single statements. They're driven by flows, structure, regulation, and long-term positioning. And right now, we are still in the early stages of understanding how all of these pieces connect together. So the real question becomes, are we witnessing early-stage institutional exploration of a new financial structure, or are we simply seeing narrative interpretation ahead of confirmed data? If you made it this far, share your thoughts below, and as always, stay informed, stay critical. Well, ladies and gentlemen, happy Friday. The markets are taking a beating today, for sure. I want to welcome all the new members of our Patreon, all the new members of the membership channels. And as always, ladies and gentlemen, remember, one good tip from the pits can easily pay for your entire year's subscription. If you want the deeper macro research and to learn how to take advantage of all of this, come and join over 450 active traders and investors in the Patreon, the Crypto Republic Desk monthly community. Welcome to all the new members, as always, where we take the PhD out of PhD. What's happening right now in the markets, again, if you're new here, this rant picks up where yesterday's rant left off. Nothing should be surprising anybody here right now. A lot of people are getting cut up like sushi every day, and they'll probably be retired from the game because they can't keep up with the swings and the whipsaws. If you look at what we said on Monday and what we said on Friday, the market will be moved by tweets. There'd be whipsaw action. You would see people getting cut up. You're seeing that now. This is probably the most exciting trading environment in my entire career I've ever seen. I've never seen it rain opportunities as it is right now. The chaos is quite deafening, right? But if you look at what's happening, again, money is following the least path of resistance, the easiest trades. Again, nobody wants to go long into this market over the weekend. Nobody. And I can understand why. So as you can see where things are right now, at the time of recording, you got XRP at $1.32. You got oil taking it. It's just unbelievable what's happening right now. Oil is at $99.68. It's probably going to be over 100 by the end, before the weekend, before the end of the trading day. Gold right now is at 4,537 and climbing. XRP, you're looking at around, I think it's around $1.32. What you see happening right now is people getting out of trades before the weekend. Again, squaring off. People can see what happens. There's more soldiers being reported sent to the Middle East, another 9,000 Marines. So a lot could be on the table happening. And again, none of this is financial advice, but you can see that the systematic risk that's going on here right now it's bleeding through everything. So I want you to listen carefully, because what I'm about to walk you through is not noise. It's a regime shift in real time. We are not in a normal market anymore, ladies and gentlemen. This is your captain speaking. Please return to your seats and buckle your seatbelt, because we are about to lose cabin pressure, okay? We're in a liquidity constrained, volatility fractured, structurally fragile system. And most people are still positioned like it's 2021. Let's break this down piece by piece, okay? If you look at the yield curve, it's telling you the truth right now. Right now, the U.S. Treasury curve looks normal on the surface. 3-month at 3.68, 2-year at 3.95%, 10-year at 4.35, 30-year pushing 4.78%. So people say, oh, the curve is steepening. Yeah, okay. No, that's lazy thinking. Very lazy thinking. Look at what actually happened just in one day. The 10-year to 2-year spread compressed from 46 basis points to 40. That's a bear flattener. And a bear flattener is not growth optimism, ladies and gentlemen. It's the bond market pricing persistent inflation pressure and structural risk, not a rate cut. Rewind that and write that down. That's very important. This is exactly what we saw in 2022. It's not a soft landing. It's not a Goldilocks scenario. It's a market saying, we don't trust the future. Now look at the volatility. This is where it gets really dangerous. The VIX is sitting at 27. Most retail investors look at this and think, okay, elevated, but do not panic. But then you look at the MOVE index, bond volatility at 115. That's the story. When bond volatility is this high and equities are not reflecting it, you get a divergence. And that divergence is critical, because bonds are the foundation of the financial system. Equities are just the expression of risk appetite on the top of that foundation. So when the move is above 100 and the VIX is lagging behind, that is a liquidity warning signal, ladies and gentlemen. I can't believe we give this away for free. This is what a liquidity hole looks like before it happens. We saw this in the late 2018s before the sell-off, early 2020 before risk assets cracked. This is not theoretical, ladies and gentlemen. This is pattern recognition. See, when you pay attention to all these little factoids and you follow them, and this is what you're watching. You're not binge watching Netflix. You're not binge watching anything. You're binge watching financial warfare. You're binge watching because you're a financial mercenary, and what you do every day matters not only to your family, but to your bank account and to the people that retain you any capacity. This is what tells us what to do and what not to do. Again, it's no different when you go to the beach and there's red flags up and there's riptides and they say, don't swim over there. Ladies and gentlemen, the credit markets are lying to you, but private markets aren't. Now, here's where it gets interesting and even more interesting. High yield spreads around 315 basis points. Investment grade, about 55 basis points. So on paper, credit looks fine, tight even. But under the surface, private credit is breaking. You've got major players, Aris, Apollo, Blue Owl, gating redemptions. That's so bad. That means investors cannot get their money out. This is not a small signal. This is a structural stress signal. This is massive. We could be doing smoke signals here. Stress, stress. People gonna be cut up like sushi. But as the remora, we feast on the chum. We feast on this again. Because what happens next? Trapped capital leads to forced selling, leads to NAV pressure, leads to more redemptions, leads to more gating. It becomes a self-reinforcing liquidity spiral. This is what's going to happen. Trying to take the PhD out of PhD, stay with me. This is how crises start quietly. Public markets lag. Private markets reveal the truth early. That's exactly what happened in 2007. Liquidity is being drained systematically. Let's talk about liquidity. Reverse repo, basically zero, 0.8 billion. That buffer is gone. Treasurer general account, 842 billion elevated. SOMA holdings declining due to QT. So your net liquidity is sitting around 5.4 trillion. But the direction is what matters. And the direction is down. Liquidity is being drained from the system. This is not stimulus. This is not neutral. This is contradiction. Let this sink in. It's so huge. And every major risk-off event in the last 15 years has had one thing in common. Liquidity was tightening. Commodities were screaming. Something's wrong. Now let's look at commodities. Oil is exploding. Brent at 105, WTI at 98.63, up 30-40% in a month. At first glance, that looks like growth. But when you look at copper, and copper is weak, Dr. Copper, then you look at gold, 4,520, and the copper to gold ratio is collapsing. That is not growth. That is fear plus inflation. It's a toxic mist, ladies and gentlemen. Supply-driven oil shock, weak industrial demand, massive safe haven demand. That combination is a classic risk off macro stress. It's so huge what's happening. And again, this is 2022 behavior. Global pressure is building quietly. Now, layer in the global context, Japan's 10-year yield is rising. USD JPY is at 158.5, pushing towards 160. This matters more than most people realize. Again, remember I told you about the Widowmaker. We watch what happens in Japan. Carry trade, no carry trade, again. Because the yen carry trade is one of the largest sources of global liquidity. And when that unwinds, it tightens dollar liquidity globally. You get forced repositioning, you get capital reparation, you get risk asset selling off. This is not hypothetical. We are already seeing early signs of that unwind. Now let's talk about XRP. XRP and the high beta risk. XRP is the chosen one. So you take all of this. Liquidity contradiction, bond volatility above 100, private credit stress, safe haven flows dominating, bear flattening yield curve, carry trade instability, and then you look at XRP sitting at 132, and you ask yourself, does this environment support high beta assets? No. This environment punishes them. That's why the probability is tilted towards downside first. A move towards 1.13 in the near term, potentially sub $1 over 3 months. Not financial advice, just our opinion. Anyone that retains any capacity before any meaningful rebound. Not because XRP is bad, not because we don't love XRP, not because XRP is 100% the future, which it is, but because liquidity is being removed from the system, ladies and gentlemen. Okay, it's like the air being taken out of a raft. And crypto is the purest expression of liquidity. The biggest mistake investors are making right now, the biggest mistake, write this down, people are looking at price instead of structure. You got to look at the price. They see tight credit spreads and think everything is fine. It's not. But the structure is breaking underneath. Private markets are stressed. Liquidity is draining. Volatility is elevated in the wrong places. Safe haven flows are dominating. This is not a bullish setup, ladies and gentlemen. This is a fragile equilibrium. So what changes the game? Now, this is important. What would invalidate this entire view? 3 things. A liquidity reversal, RRP rising, Fed balance sheet expanding, a collapse in bond volatility, move back below 90, true credit reflection signal, high yield spreads tightening aggressively with growth. Until those happen, this is a defensive regime. So the bottom line, what I just said again, we're in a market where liquidity is contracting, volatility is elevated, credit stress is building beneath the surface, global funding pressures are rising, and yet most investors are still positioning for the upside. The disconnect is where opportunity is created, but also where risk is misunderstood. This is not the time to chase. This is the time to understand the regime. Because in markets like this, the difference between winning and losing is not intelligence. It's positioning relative liquidity. Ladies and gentlemen, if you understand this, you're ahead of 90% of the market already. Again, there is so many things happening right now and so many moving pieces going on. It's unbelievable. And in the chorus of chaos that's going on, it's so hard to not take advantage of what's happening. Again, so when you look at everything and you take a step back and you can see the ranges where they're going, it really tells you a picture of what's happening. The market plays an entire week as if a year. And what I mean by an entire week as a year, people are making profit in a week's time that would normally have taken a year by the price swings that are going on, through discipline. And that's why, ladies and gentlemen, I'm going to say this again. One good tip from the pits can easily pay for your entire year subscription. If you want the deeper macro research to learn how to take advantage of all this, come and join over 450 active traders, investors in the Patreon, the Crypto Republic Desk Monthly. Again, we're showing people how to capitalize off of the chaos, what's happening. There's so many opportunities, what's happening right now. It's truly unbelievable. It really, really is. But ladies and gentlemen, this is the next thing that we're paying attention to. And we gave out a massive call in the tips from the pits with this one. And we're giving out other ones. Because as the minutia builds, as people are only paying attention to gold, silver, oil, the big names, DYX, the things that we're going over, they're not paying attention to the further downstream plays that become almost a home run to do because no one's paying attention, because most people don't study this. As a financial mercenary, this is all we study. This is all we know. This is all we do. We study these things so when the time comes to take advantage, we're ready 100%. Because, ladies and gentlemen, and I can't believe I give this away for free, but the oil crisis isn't just an oil crisis. You can't have a party without helium balloons, ladies and gentlemen. There's a helium problem no one's talking about. Helium is one of the best examples of a hidden strategic commodity. And the U.S. situation is a mix between mistaken policies, geopolitical demand increase causing supply and concerns. Now with the war in the Middle East, we're seeing a perfect storm with helium. Ladies and gentlemen, most people don't pay attention. I pay attention to anything that can make us money. Again, not financial advice, just my own opinion, anyone that retains any capacity. Helium is produced as a byproduct of natural gas drilling. Its unique properties on non-reactive gas and supercooling liquid make it invaluable for MRI machines. Let that sink in. Rocket fuel. Again, so look at the current dynamics and we go forward with this. Stay with me. I'm tying all this into crypto. There's pinching supplies. So if you look at the whole helium, the U.S. government first began collecting in 1925. This was for military airship surveillance, mostly for NASA and Cold War technology. This gave the U.S. a near monopoly on helium. The reserves held 1 billion cubic meters extracted from gas production. Wait to see how much this costs. However, after reserves grew, something happened in 1996. Congress passed the Helium Privatization Act in 1996, where the government was ordered to sell off the reserves since it was deemed no longer strategic. Stay with me. They deemed it was no longer strategic. Ring a bell? How many things are deemed strategic in today's world now? The reasons: the reserve had accumulated $1.4 billion in debt after borrowing money from the Treasury to build the infrastructure to storage helium, okay? So it was one problem led to another. They had a monopoly, so they dumped all the supply in the market, and helium was sold below market prices. The cheap gas crushed private investment, new supply from private companies. They couldn't turn a profit, but the demand was rising again, but private supply still hadn't a chance to grow enough inventory, okay? The reserve is winding down with no upside supply coming in. Industries panicked. MRI, semiconductors, research. This caused Congress to act, as they always did, by signing the Helium Stewardship Act of 2013. The United States causes a problem, finds a solution, and in between there's the ability to make a lot of alpha if you're paying attention to these things. So we pay attention to this. Again, I can't believe we give this away for free. It's crazy. Okay, so this slowed the sell-off of induced auctions. The government maintained a controlled sell-off from 2013 to 2024 when it finally sold off its federal helium reserves. Now, if you look at what's going on right now, the distribution infrastructure spans from Texas, Kansas, and Oklahoma. They got about 1 billion cubic feet of gas, okay? Ladies and gentlemen, this is what it means to take the PhD out of PhD. 95% of global helium is a byproduct of natural gas, okay? Such helium production cannot be scaled without demand unless there is a corresponding increase in natural gas production that can be extracted and sold profitably. Ladies and gentlemen, this is going to shock you. Helium is $100,000 per metric ton. $100,000. Now for natural gas, it's $200. So if we fast forward to what's happening right now, geographically, supplies tied to places like Qatar, Algeria, and Russia. Qatar has around a third of the global supply. Disruption has created a huge supply shock now. Now the market's missing millions of cubic meters per month. Whereas yet 10 to 15% comes from Algeria, not the friendliest of sorts of the USA. And Russia produces 10% of global supply, but sanctioned infrastructure scale remain a problem. This problem is further complicated by the fact it's not mined normally. Rather, again, this is the big important thing. It's a byproduct of natural gas. New domestic shale deposits hold very little helium. Nature. Helium is being so light, literally escapes the planet. There's no recovery process for it. Storage is very difficult. It must be compressed, liquefied, specialized equipment. This requires investment and correct infrastructure. Ladies and gentlemen, healthcare is beginning to panic. MRI machines need thousands of liters of liquid helium to function. Just think about that. Healthcare workers across the United States say they can't afford any disruption to the helium supply chain. Lucky for the U.S., we're sitting on top of the largest deposits of helium in the world to get moving again. So, in short, supplies are disrupted in recent years. The largest domestic deposit history of managing helium and growing demand. Ladies and gentlemen, if you want to see where the next big play that we're getting involved with, do come and join the Tips from the Pits, because what's going to happen in helium is massive, massive again. So I want you to understand this. Helium is more than just a gas. It's a case study in how government intervention can distort a strategic market. Let that sink in. The United States built the world's helium system, dismantled it through mispriced privatization, and ultimately exited the market entirely in 2024, transferring not just supply but infrastructure control to private hands. So if you look at what's happening, what I just went through, the demand for helium, and it's so crazy that there's no, at the same time, helium has no substitutes. It can't be recycled once lost, and it's difficult to store at scale. Hence, none of this can be ignored. So when you look at the demand, semiconductors, defense, and you have to get natural gas to get helium. With recent geopolitical disruptions and prior shortfalls still fresh, the market is once again tightening. So healthcare systems already signaling once concerned advanced manufacturing remains high. The U.S. is still in a good spot, but it raises a simple question. How long before helium becomes strategic again? How long before it becomes strategic again? The United States has strategic for metals now, right? So it suggests that when the critical inputs become scarce, especially those tied to defense and technology leadership, policy flows. So again, ladies and gentlemen, they need helium. If you want to see how we're going to take advantage of this, other ones, do come and join us in the Patreon at the Crypto Desk Republic Monthly. One Tip from the Pit covers your entire year subscription and join over 450 active traders and investors taking advantages every day. Ladies and gentlemen, these weird things that are going on makes the difference. Because people don't realize how expensive something is. People don't realize what's involved. People never took the time to realize what's happening in globalization and the supply chain disruption. That's why people are getting fully cut up like sushi. But sometimes the further downstream plays are better. But I want you to understand something. Let me be very clear with you right now. We're witnessing in global markets is not noise. It's not volatility. It's not a temporary repricing. It's the early stage fracture of a system that has been held together by liquidity, leverage, and blind confidence for over a decade. And the most dangerous part, the market's still pricing this like nothing is wrong. Ladies and gentlemen, the signal everyone's ignoring as far as we're concerned, not financial advice. Let's start with something almost nobody's talking about, but should be. Turkey just sold 22 tons of gold in a single week. That is not portfolio rebalancing. That is not tactical allocation. That is distress. Gold is the asset you hold when everything else breaks. It is what central banks use when they have no other option. So when a central bank, especially one that is structurally dependent on energy reports, starts liquidating gold at this pace, it means the pressure is already here. It's not coming. It's not building. It's here. Let this sink in. And if you've been through enough cycles, you recognize this pattern immediately. We saw it in 2018. We saw it in 2022. And every single time it didn't stay contained, it spread. So if you look at the oil shock, let's zoom out here, because what's happening here is part of a much larger mechanism that most investors completely misunderstand. 2022, oil prices surged. Something very specific happened. 435 billion in U.S. treasuries were liquidated by Asia. 164 billion sold by European economies. Over 1.3 trillion in global equity flows. Why? Because countries needed dollars to buy energy. Countries needed dollars to buy energy. And how do you get dollars? You sell assets, treasuries, equities, reserves. That selling pushes yields higher. Higher yields strengthen the dollar. A stronger dollar makes oil more expensive in local currencies, which forces more selling. This is a self-reinforcing loop. And right now that loop is starting back again. Oil volatility is back. Reserve stress is visible, and central banks are already reacting. But markets, they're acting like the mechanism doesn't exist. So if you look at the illusion of stability, let's talk about credit markets. This is crazy because this is where the real complacency lives. High yield spreads barely moved. They widened slightly, but they're still sitting near levels that historically precede massive blowouts. Meanwhile, something far more important is happening under the surface. Investment grade credit is underperforming high yield on duration adjusted basements. That is so huge. My God, that should not happen in a healthy system. It's not. That tells you something very specific. This is not about default risk, ladies and gentlemen, not yet. This is about interest rate risk. This is about duration. Let that sink in, write that down. This is about the fact that the entire system was built on the assumption that rates would stay low forever. And now that assumption is breaking. So in our opinion, the time bomb in private credit that no one's talking about, let's go one layer deeper, private credit. This is one of the most underappreciated risks in the entire financial system right now. We're talking about a market that has grown to rival traditional banking, and where that exposure concentrated, software, technology, growth-dependent companies. These businesses rely on cheap capital, stable growth, predictable refinancing conditions. Now imagine what happens when refinancing costs jump 150 to 250 basis points. Imagine. Margins compress, cash flow weakens, confidence get breached, and all of a sudden, what looks like a stable yield becomes forced selling. This is how you get a cascade, not gradually all at once. So the lag that traps investors, and here's where most investors get cut up like sushi, unfortunately, and get carried out. They say earnings are still strong, defaults are still low, the economy looks fine. Of course it does, because credit always lags, always does. But by the time earnings roll over, market's already deep into the drawdown. This happens every cycle, and it's happening again. Ladies and gentlemen, let me go over this again. I'm going to drill this into your head. The $10 trillion problem. Let's talk about the elephant in the room. The United States has to refinance $10 trillion of debt in the next 12 months. $10 trillion. At current yields, that locks in roughly $450 billion in additional annual interest expenses. Ladies and gentlemen, that's not stimulus. That's not growth. That is pure drag. And when you combine that with a projected $1.9 trillion in fiscal deficit, you get a system that has no flexibility left, no buffer, no margin for error. So let's put this all together. Central banks are selling reserves. Oil-driven liquidity stress is reemerging. Credit markets are mispricing duration risk. Private credit is structural fragile. The U.S. is locking in massive interest rate costs. There is only one way this resolves. When the system tightens too much, when growth slows, when markets break, policy responds, liquidity returns, balance sheets expand. Not because they want to, because they have to. So before this happens, though, you get the reset. You get the 15 to 20% equity drawdown. You get yields pushing higher towards 4.6%, maybe 4.7%. You get forced selling. You get positioning unwinds. You get panic. And that is where opportunity is created, ladies and gentlemen. This is not a normal cycle. It's not. This is not a soft landing setup. This is a transition from a world defined by cheap money, stable inflation, endless liquidity, to one that's defined by volatility, scarcity, and policy constraint. And in that world, the winners are not the ones chasing momentum. They're the ones who understand where liquidity breaks, where stress emerges, and where the system is forced to respond. Because at the end of this cycle, real assets win, liquidity wins, preparation wins, and everyone else, they learn the hard way. They get cut up like sushi, unfortunately. The markets don't wait for consensus to catch up. Ladies and gentlemen, I'm going over a lot, and I'm trying to take the PhD out of PhD. But all the things that I go over every day, and I just did, they're responding to ranges. They're responding to discipline. The market players who have been playing forever are taking advantage of this. And again, if you want to take advantage of all the chaos and opportunities that the chaos is causing, do come and join us, because I'm going to tell you one more time. One good tip from the pits can easily pay for your entire year subscription. If you want the deeper macro research and learn how to take advantage of all this, come and join over 450 active traders and investors in the Patreon, the Crypto Republic Desk monthly. And again, it doesn't matter if you're brand new and you're just starting out or you're very advanced. You'll learn how to become a financial mercenary, ladies and gentlemen. Yesterday, Better Home and Finance Holding Company and Coinbase revealed a partnership to bring token-backed mortgages to millions of Americans. The development represents the latest example of crypto's continued integration with the U.S. economy. According to a joint announcement on the effort, token-backed mortgages are originated and serviced by Better and benefit from the same backing of Fannie Mae as other conforming mortgages. Under the partnership, U.S. residents that qualify for a mortgage with Better will now be able to use BTC or USDC as collateral to fund their cash down payments. Borrowers will be able to secure a standard conforming mortgage without liquidating their crypto holdings and potentially trigger a taxable event. The announcement further points that the report suggests 52 million Americans adults, or 20% of American adults, have owned digital assets. Additionally, details of the offering include digital asset pledges tied to a separate privately financed loan, the proceeds of which are used to fund the down payment. The mortgages are originated as standard conforming loans in line with Fannie Mae and guidelines. No margin calls or top-ups, declines in BTC do not affect mortgage terms or trigger liquidation. Collateral is only liquidated in the event of a 60-day payment delinquency, consistent with standard mortgage structures. Pledged USDC earns rewards that can offset payments, lowering the effective interest rates. Flexible collateral structure allows partial pledging of select assets with plans to expand to additional digital assets like tokenized equities, fixed income, and other tokenized real estate assets. Ladies and gentlemen, that's so huge. In June, the Federal Housing Finance Agency ordered Fannie Mae and Freddie Mac to propose how to consider cryptocurrencies as assets in mortgage risk assessments. The order explained cryptocurrency is an emerging asset class that may offer an opportunity to build wealth outside of the stock and bond market. It's also noted that cryptocurrency has not typically been considered in the mortgage risk assessment process for mortgage loans delivered to the enterprises without converting the cryptocurrency to US dollars prior to loan closing. So the takeaway, ladies and gentlemen, in February, we wrote a note to the people that retain us in any capacity. Despite digital assets' ongoing sell-off, momentum behind institutional substitution is unlikely to abate. The latest headline underscores that this trend has continued in the digital assets' deeper integration. The U.S. economy has significant inertia despite the latest volatility. So when you take this into situation, ladies and gentlemen, you take this all into situation and you make it your situational awareness, the adoption of digital assets here. If you can use it for a loan down payment now, all the mortgage brokers who watch here and are in the Patreon, we're always chatting about rates. We can't believe what's happening. This is the beginning of, in our opinion, the adoption into everyday use as far as we're concerned. And that's very, very big. The other big thing that we think that is very important to pay attention to is how much further downstream that goes, how much easier it gets. We believe the Clarity Act gets done. We're in that camp. Something else we think is important. David Sachs announced he is leaving the White House AI and crypto czar role to join the President's Council of Advisors on Science and Technology. Sachs oversaw the White House early crypto efforts, with included the passage of the Genius Act. We believe that's very, very important because, again, the world is changing. And I always tell you to pay attention to what's quiet, right? And the other thing that we're paying attention to, Anchorage Digital has announced support for the Tron blockchain, starting with institutional custody for TRX and plans to add TRC20 assets and native TRX staking. This move is described as providing U.S. institutions with a compliant way to hold and stake TRX, integrating Tron into Anchorage regulated platform. Ladies and gentlemen, it's massive. It's just massive. You see it happening everywhere. Again, you see these things happening. And it's whether or not you really want to take advantage of it. You know, for all of our fans in Australia, a federal court in Australia ordered Ozturs, O-Z-T-U-R-E-S trading, to operating as Binance Australia derivatives to pay USD 6.9 million penalty for misclassifying retail clients. Over 85% of their client base was incorrectly categorized, leading to exposure to high-risk crypto derivatives, incurring around 6.3 million in losses, USD 2.6 million in fines. That's rough. So the thing that I'm also paying attention, Bitcoin faces around 14 billion options expiry while the Middle East is in chaos. And again, you can see the market flow from yay to oh my God, yay to oh my God, yay, oh my God. The chaos that we believe we're going lower from here. We believe that there'll be lows that will give the last opportunity to get at very, very rock bottom prices before Operation Print It to Win It begins. Once Operation Print It to Win It begins, we're going to look back and say, wow, I wish I would have gotten more of these levels. Again, so we're going to see things happen because it's a powder keg and it's going to blow at some point. And when these things do blow, like a Mount Vesuvius, it's the discipline, the money management, the trade size, the conviction, that Gucci clarity. And if you made it to this point in the video, you got that Gucci clarity of knowing where you're going and why. Take advantage of the chaos while you can, ladies and gentlemen. And if you want, come and join us in the Patreon. We'll show you how we're taking advantage of the chaos. Again, this content is for informational and entertainment purposes only. and should not be taken as financial advice. Always do your own research and consult a licensed financial advisor before making any investment decisions, always. Remember, the game is changing, and those who understand it first will benefit most. Make sure you're on the right side of it. You have two choices. You can be like the crowd, reacting after the move, rationalizing why they missed it, telling themselves they'll never let it happen again, or you can be the one who saw behind the curtain, the one who understood the infrastructure shift, the one who positioned early, not randomly, but intentionally, because some moments in history are loud, but the ones that change everything are quiet, right up until the moment they're not. And this is one of those moments. Do not blink, because the world is distracting with noise while XRP continues developing behind the scenes and building momentum in the broader digital asset landscape. Stay sharp, stay informed, accumulate knowledge. Your move now will be remembered. This is not the end of the story. This is just the beginning. This opened your eyes. Smash that like button, ring that bell, and leave a comment with your thoughts. Turn on notifications, and most importantly, subscribe to the Crypto Republic. We break down the major global banking trends shaping digital assets today, giving you context, clarity, and research you can use. Don't just watch history happen. Stay informed, stay ahead, stay in the Republic. I love you all. I'll see you in the Patreon.